Hello and welcome everyone to today's 10 Capital Network's quick pitch event. My name is David Garza and I will be hosting the event for today, as well as passing the mic over to one of our panelists today, Debbie Klein. Debbie, if you want to go ahead and present yourself and give us a little bit of information about what you do, why you're here, and what you'll be doing here as well, that would be great. So without further ado, Debbie, mic's on
Great.
you.
Great. Nice to meet everybody. My name's Debbie Klein. I'm the co-founder of Buzzy Rocket. We were founded about just shy of 15 years ago after a background in sales and marketing and advertising. My co-founder and I decided that after spending time in corporate America and startups, that startups are where our heart was. So we focus on strategic marketing and go-to-market execution, all the way from design and development of logos and websites through strategy, full execution. But we are a small boutique agency. We only take on 6 clients at a time, and we are passionate about giving back to the startup community, and we love learning and meeting smart people. So we were thrilled to be part of the 10 Capital Network pitch event today. So thanks for having me.
Perfect. Thanks, Debbie. Appreciate that. Without further ado, now, guys, we will pass on the mic to Enrichly. So, Enrichly, if you guys want to put up your slide now and begin your presentation, you will have 15 minutes to give us everything you got.
Okay, hold on just a second. Let me pull it up in presentation mode. There, everybody got that?
Yes,
Yep,
sir.
looks great.
All right. Enrichly Technologies. Enrichly is disrupting the multi-billion-dollar membership organization world. I think most investors, most business people belong to some kind of a member organization, whether it's Rotary or Kiwanis, the Masons, Hereditary Society, university-based Greek organizations. All of these organizations have three things in common. Number one, their members are intensely loyal and very brand conscious. Number two, their members buy a lot of stuff. They buy shirts, t-shirts, polos, jerseys, hats, jewelry. And the third thing is that for the most part, most of these organizations have been taken advantage of by predatory investors over the years who have either not been licensed and not generating ancillary revenue through royalties so that these organizations can keep their membership low. So what Enrichly is doing is leveraging on that brand loyalty of these affluent and eager consumers and solving that that ancillary revenue issue for their client organizations. We're starting in the world of university-based Greek organizations because this is what we know. Everybody on our board, everybody on our team is a member of a Greek organization. And this is where, because of our knowledge of the industry, we have the strongest competitive moat. You see here the leaders of our organization. With our founder is the CEO of a major fraternity. Also sitting on our board is another CEO of a fraternity, a COO of a large women's organization, a sorority. You see a lot of gray hair here. I want to assure you that these are the strategic leaders. Our operating team, their average age is 27, so they understand our consumer. Think of Enrichly as being like if a bunch of contractors had gotten together and founded Home Depot because they were tired of being taken advantage of by their suppliers. That's what brought everybody together. So here's how we work. Enrichly has developed a white labeled online storefront that we make available to our client organizations. This investment has already been made. So the cost to personalize that website for any new client is minimal. It's all branded with the organization's name to take advantage of that brand loyalty that their members already have. It doesn't take much to get any client up and running on our platform. With the support of our national organizations, our contracts are with the national organization, not with the local chapters. and that's where the storefront is. But with the cooperation of those national organizations, we also are establishing a presence at the chapter level to manage bulk sales. There are, believe it or not, 175,000 new men and women join undergraduate Greek organizations every year. And the first thing they do as soon as they're brought in is they want to buy something, usually with their parents' credit card. They'll go out and buy a jersey or a t-shirt or a hat or all of the above. And the nice thing about these organizations at the local level is they have a cadence of events where they have recruitment, homecoming, parents' weekend, and they buy T-shirts and other merchandise for all of those events. Our business model is actually very simple. This is the way we make money. We buy merchandise from pre-vetted and licensed vendors who produce the products. We have it embroidered or printed with the organization's intellectual property, with their logos or their name. The vendor pays a royalty. This royalty comes from the vendor, not from us, and they pay a royalty. Our licensing company, CLC, takes a small part of that. The rest of it goes to the Greek organization itself. And then Enrichly will feature the product either on the fraternity or sorority's national website, or it'll be part of a bulk sale at the chapter level. We mark it up about 75%, which generates about a 43% gross margin. The gross margin on bulk sales, T-shirts at the local level is usually smaller, but the markup on products on the storefront, particularly in the case of branded products with jewelry and that sort of thing, is higher. So we try to average about a 43% gross margin. Below the gross margin line, we also have significant leverage at the SG&A line because we've already made the investment in the white labeled platform, and all we need to do is brand it for the new client. We try to stay out of the supply chain as much as we can. Most of our products are made to order, so we don't have to worry about carrying inventories and that sort of thing. We have, because of our model, we've been generating revenue since day one. We have three of the largest men's organizations, Lambda Chi Alpha, Phi Delta, and Teak. We have 10-year contracts with each of those organizations. We have just this past June brought in our first women's organization, Alpha Gamma Delta. And our growth story is good. 2024 was our first full year of business, and our revenues were 283,000. We're on track in 2025 to hit over 800,000. That's a 3x increase in our revenues. This past July, we had our first $100,000 month, and this is at a time when the kids weren't even in school. So that's worked out really nicely. Our first sorority coming in has opened the door for other sororities. In the Greek world, to be very honest, there are a lot of followers. Everybody wants to be first to be second. So as soon as somebody else comes in, then people start knocking on the door. We have a 10-year agreement now with the United States JCs. This is our first entree into the non-Greek world, and it's proof of concept for us that this can work not just in the Greek world, but in the $13 billion non-Greek membership world. The JCs have introduced us to the International JCs, which has chapters in 50 plus countries around the world, 140,000 members. They've also introduced us to the National Association of Asian American Professionals, another non-Greek organization. So our non-Greek presence is expanding as well. We establish pop-up stores in addition to the storefront. We'll go to a conference and we'll set up a display, and we'll have an actual store right there on site. We had one at a Phi Delta conference back in July and made $50,000 in just 3 days. Shows you what these people will buy when they see it. And we have just on Monday, frankly, of this week, we have received an inquiry from our what would be our fifth fraternity, which is Delta Sigma Phi. Delta Sig is one of the larger fraternities, about 110 chapters, and their CEO is very well respected in the industry, sits on the National Interfraternity Board, and we think that may open up a lot of doors for us. So this is why we're here. We have one of those great problems that sometimes happen with startups where we are outgrowing our cash. We need money to hire the personnel to service these clients. This is a high touch thing. We want our clients always to be happy. I think in the whole year of 2025, we had 8 returns. So we don't have a problem with that. But in order to maintain that level of service, we need to hire personnel. So that's why we're trying to raise money now. We calculate that if we're holding a lot of these clients at arm's length, frankly. And if we can bring in 4 or 5 of these new organizations who are approaching us, then we should hit positive cash flow in 2027. But we need to get over this hump, this initial cash hump, so we can hire the people to get this done. Our founder likes to say we may not be a unicorn, but we're a hell of a thoroughbred. What he means by that is if somebody's looking for a 50x or a 100x return in 10 years, they're not going to get it from us. We're not your guys. But if you're looking for a 3x return over the next 3 years, or perhaps 6 to 10x over the next 4 years, then you should take a look. There are a few things that I try to always say to investors. First, this is a simple model. We're not trying to create a new product, create a market. We're just taking advantage of the brand loyalty and the demand that's already out there. Secondly, we are not building an Enrichly brand. We don't care if anybody even knows we exist from our customer perspective. We are leveraging on the loyalty that they have already to their existing organization. And it's a tremendous, intense brand loyalty. And secondly, and lastly, we've already proven that we can work in the non-Greek space with the JCs and the other organizations, APO that has just come on. So we're very excited about where we are on the growth side. Finally, on the exit side, we've got that all figured out. We've got several candidates. CLC, which is our licensing company, tried to break into the Greek world about 15 years ago and failed because they didn't have the connections that we have, and we think that they may be taking us for a test drive, frankly, and they're a division of Learfield, which has a lot of money. Bill Highway is a company where they've got a lot of interest in the Greek world. They're rolling up the Greek world on the billing side, on the financial side, and we've already had some discussions with them. Follett is a company that runs the bookstores at major universities, and they'd be interested in co-branding with us so that you could get a shirt that says both the university name and your fraternity name all at the same time. So there are lots of exit opportunities that are already out there. That's it. I think you said there was going to be a clock. I don't know whether I've used up all my time or not, but I would be pleased to answer any questions that anybody might have.
Yeah, no, we actually have about 3 minutes and 30 seconds. I also did want to say that we did have one of our partners come into the room as well to sit on the panel, Mohammed Hachicha. If you wanted to, Mohammed, if you are there, wanted to give a quick little introduction on yourself before you ask up any questions to Enrichly. And after Mohammed goes, then Debbie, if you have any questions, we would love to follow up with that.
Hey,
Great.
hi guys. Sorry I was a little bit late. I got into a car accident on my way to the office, so I needed to deal with that. Just a fender bender, but I wasn't at fault, but I had to deal with it. I'm Mohammed Ahsisa. I'm the founder and CEO of Crown Acquisition Group. We help support startups, Series A, Series B, and seed VC-backed startups with optimizing their financial operation, fundraising strategy. And I partner with 10 Capital Network and Hold to kind of help the companies coming through the 10 Capital looking to fundraise and try to guide them in any way possible and bring support if I can bring support.
Love it. Now, if you just want to follow up with any questions you have about Enrichly, And then after
Yeah,
your set of questions, then we'll follow up with Debbie.
yeah, absolutely. So usually I always ask the same questions around this presentation, which is in the short term, what are the key risks for Enrichly, and what are the top three priorities that you feel would make the company move faster than it is right now? Is it only a link to funds? Is it linked to, for example, permits like FDA approval, which is not in your case, right? But
Yeah.
approval, regulatory approval of some sort. What are the things holding you back from reaching the goals that you want to reach?
Sure. And the answer to that is cash. I said that it's easy for us to stand up a new client, and it is. But we also, for example, the conference that we're talking about, doing for Alpha Phi Omega in December, we'll probably have to invest $50,000 or $60,000 in inventory. We'll get paid for that because it turns around pretty quickly on the revenue side. But we do have to upfront the money, and so there's a little bit of inventory that we carry. But our primary concern is personnel. We need to hire the people that we need to service the customers and make sure that they get everything that they want. And again, that's just a cash issue. So we are not cash flow positive yet. We could be pretty quickly with with these new clients coming in. But that's it. So I think that's also what our key priorities are, is making sure that the customers get serviced. We certainly don't have any regulatory issues or anything like that. No fixed costs. We frankly, between us, we don't even have an office. So when somebody asks me, where are you? I say, well, I'm in St. Louis. I don't know where the hell everybody else is. But we don't have any overhead to worry about. Our SG&A leverage is significant. So we're real pleased with that.
Perfect. Thank you. Thank you, Len.
Do you mind if I jump in with one?
No, go ahead. Sure.
Great. It is kind of playing off of that question. You mentioned, you had an impressive board and executive team that you shared, and it's always great to see that somebody like, your Home Depot example, they're coming, they know the market that they're getting
Yeah.
into. And you mentioned the younger age of the operational team. So when you kind of combine your operational team, your go-to-market strategy, looking at both, like, you mentioned you've done pop-ups, you've done these different things. So what does the organizational team look, your org look like right now, that non-executive side? And is it like a one-to-many? What is your go-to-market strategy? Like, we're going to hire tons of salespeople, what would that be?
Yeah, we've got right now our team is quite small if you include me, which I'm not really even on the payroll, but it's still kind of a job. Our chief operating officer oversees everybody. Well, actually, our CEO oversees everybody, but the chief operating officer oversees the operations. We have a graphic designer who designs all of these logos and T-shirts and things like that to make sure that they comply with licensing. We don't want people putting Budweiser and Bass Pro on their shirts. We want to make sure that it doesn't violate anything. We've just hired another designer because he was becoming kind of overwhelmed. We have a client service rep whose job is to work with the organizations. And that's really it at this point. What we really need to do is hire more client service people. And we think for every 3 to 5 organizations, we'll need somebody new. And then we're going to have contractors at the chapter level where we're actually going to pay them a 2% cash back if they coordinate the bulk sales for us.
So it sounds like really the funds for scalability, right? To repeat the success is what you're going on there.
That's exactly right.
Let's see. I have some more detailed ones that I can ask a couple now and a couple later. And then one of the early slides you talked about partnerships, and I think it had a bunch of different brand names. I don't recall, like Vineyard Vines or whoever it may be. Are those partnerships that you have that you're hoping, like targets that you're looking for? Are those ones that the fraternities themselves have? I didn't quite understand what those partnerships were.
Yeah, these are our suppliers. For example, we put a logo on a Johnny O polo. Lululemon is big. I'm not sure. These fashions change
Sure.
frequently, so it's but Vineyard Vines, those are relationships that we have through our embroidery company. We have a relationship with an embroidery
Got it.
company, and they have the licenses for all of these vendors, and they secure the raw materials, they embroider, and then they ship. So that's what all of those brand names that you saw, those constitute the products that we sell.
And then I think my last question, and again, I looked at this quickly for the first time. My last question would be, do you have a breakdown roughly of e-commerce versus events like your pop-ups?
Yeah, we started with on the e-commerce side. The conference business is not quite as big yet, although that creates some fluctuations in cash flow because they're heavy over the summer and in January, and then not much during the rest of the year. The bulk sales is an engine that we're just now beginning to roll out. I think that we'll sell more on the bulk sales side than we will on the storefront side because that's at the chapter level. But we're only beginning with that. So far, virtually all of our revenues now have been through the e-commerce storefronts.
Great. Thank you. I
Sure.
can't see a counter, so I can't quite tell if
Yeah,
I don't want to go over and we can always continue
I
in a
lost
breakout
track
room.
as well.
Love
And
it,
I
guys. All right.
apologize to everybody on the call. I have to go jump on a plane myself, and I won't be here for the breakout sessions. So I apologize for splitting early.
No, no worries. If anything that works, that we get to ask all the questions out of the way. If
Great.
anything, safe travels
Yep.
and great presentation. Without further ado, though, guys, we will be passing the mic on to Buddy. So, Buddy, if you want to put up your slides and pass on the mic on to you.
Sure, I'm happy to do so. All right, let's see if we can get this working right.
We practice.
We did practice, yes. All right, so here we go. Let's see. And action. Yes? Okay.
All right.
Love it.
All right, so what is Buddy? Betting shows and movies for pet people. So it's a specialty streaming app. So in the streaming space, you have what are called premium streaming services, which would be Netflix and Disney Plus and HBO Max, those guys. And then there are a lot of specialty streamers. And so ones you may not be familiar with, you've got BritBox, which is British content, Shudder, horror films, and Crunchyroll, which is actually massive. They sold, yeah, they have nothing but anime, and they sold to Sony in 2019 for 1.2 billion. So there's a lot of specialty streaming apps that are growing right now. Buddy is a specialty streaming app focused on Gen Z millennial pet parents. So these are pet parents, not pet owners. These are people that love their pets, that are obsessed with their pets, and Buddy services those. So we have all kinds of movies, TV shows, documentaries. We have some originals that we are using with YouTube creators, and we're $7.99 a month, ad free, $7.99 a year, and we reach profitability with 75,000 subscribers. As you know, the pet market is huge. 86.9 million homes own a pet. In 2022, they spent 136 billion on their pets. So there's a lot of growth there. And in the niche streamer or specialty streamer market, that's where all the growth is. There isn't any really, the premium streamers are kind of leveling off. Most of the growth is in the specialty streamer space. So, Buddy, we solve a lot of problems for people who like streaming services. So this poll is done by top 3 reasons why people watch subscription video on demand. As the shows I want, binge watching, on demand access. So we solve all those needs. And again, it's about finding the right content, and we have some great TV shows and documentaries on there as well. So what else is out there in the space? There are these are all brand new services that are out there. Dog TV, Love Pets, Bark TV. Love Pets is a fast channel, so it is not a video on demand service. Bark TV is also a fast channel, not video on demand. Dog TV is video on demand, but it is for dogs. So this is Dog TV, is TV for your dogs to watch when you're not home. Buddy is for humans to watch. It is not for dogs to watch. But Dog TV has over 400,000 subscribers. in the US. So even just being a subscription model for dogs, they do pretty well. So what is the total addressable market, service available market? Here's we invested in hiring a research firm, the research agency that did the plan for BritBox. We had them do our research, and they identified this market for us. So there are 87 million pet owners, but of those, there are 60 million who are pet parents and they already subscribe to several streaming services. So that is our market that we're going to go after. Within that 60 million, we have identified the initial target that we're going to go after, which is those who watch specific programs. So we've identified programs that are similar to the content that we have, like The Dog Whisperer, Pitbull and Parolees, the different vet shows and the Rocky Mountain Vets and different shows. We know they're already streaming and they're watching those shows, and we're going to target those subscribers or those viewers to subscribe to our service. Our go-to-market strategy is, like we said, we're going to work with the Media Plus agency, who's done all the research. They have the plan. That's why we're raising funds, so that we can go to market with this group, and try do a test market in the Dallas Fort Worth area. That's the first market that we're going to invest in, and go to market and see what kind of reaction we get, and see how many subscribers we can get. The team is myself. I'm the executive vice president of programming. We have Ryan and Layla. Layla is the CEO. Ryan is the COO. They are husband and wife, and they themselves couldn't be here today, but they're very invested in Buddy's future. They've invested already over $1 million in building the app, getting the app in all the app stores, and securing all the content. So this is kind of what we've been up to lately. So we built the app. It's in 91% of connected TV app stores. So Roku, Apple, you name Samsung TV, Google TV, Android TV. We're in all the devices, all the app stores. You search for Buddy, we'll be there. We just got into Samsung. That was the last big one that we got in just a few months ago. We don't want to go to market until we're in all the app stores, because the last thing you want is somebody trying to find your app and they can't find it. So we've been busy working, but we have all the content and the plan ready to go. So the future brings a lot of interesting things. We have a segment of our app called AI Buddy Helps, and we're going to really expand that. We really want to be able to service people based on what they're watching, using AI as a search tool. Right now, searching and streaming apps is very difficult. Discoverability is the hardest thing, to find the right content for the right people, and largely because most search windows on apps are entirely title dependent. So you have to know the name of what you want to watch. The future is a lot more interactive, where you can say, I want a reality show about dogs. I'd like to see a documentary about, kittens or whatever. And the content the content is searchable like that. So that's just one of the things that we want to do. A proprietary platform, merchandise, e-commerce, treats and tie-ins, all that good stuff is in the plans. Exit strategies. Like I say, Sony is one in particular. They like to invest in specialty streamers or buy them flat out. They bought Crunchyroll for $1.2 billion. There we can merge with similar services. There's acquisition by a major pet brand. This could be something that we're starting to see the edge of, is major brands going into specialty streaming, or subscription models, I mean. So they're starting to see lifestyle bundles of streaming, and so I think that is something we want to explore down the road. But we're talking about 5 years from now, so we don't plan on looking for an exit until at least 5 years from now. Why is Buddy a winner? Again, the specialty streaming space is growing right now. We have a plan put together. There is, do we think, our plan, just so you know, in our financial model, we are not projecting to have millions of subscribers. In 5 years out, we're projecting to have 600,000 subscribers. I think that's very conservative. We all think that's very conservative, but that's what we're projecting in our model. Because again, it's a specialty space. It is not we're not trying to compete with Netflix. So right now we're raising 500,000, which is, that's with the current valuation of 5 million. And there we have 125,000 in interest and committed. I think about 100,000 of that is already committed. Eventually, we will have to raise a total of 5 million before we get to profitability. So that is, part of the plan for our model. This is the initial use of funds for the seed. Like I say, we're going to get this 500,000, and we're going to go to market in a test market. And so largely that's what that's for, so that we can go to market, get some sales in the door, see what our customer acquisition costs are, see what messaging works, and really get a lot of good data from that, plus some subscribers, and then we go for the Series A, so that we can invest more in programming and more marketing, and take what works and use that in more markets. Our 5-year plan here is, what we're projecting is in year 5, revenue will be around 120 million. EBITDA will be around, I believe, around 25, 28 million in the 5th year. We turn profitability in year 3. We just kind of start to turn the corner in year 3. And that is it. I think I set a new record. No, I did. Pretty good. 5 minutes left. That's not bad. 10 minutes goes by quickly. So happy to answer any questions.
Great. I have a few to start, and then Mohammed certainly jump in. Some of these are, first of all, it's a great target market, great presentation, nice and succinct, easy to understand.
Thank you.
Do you have a couple questions? One is, some are kind of light. Did you choose the test market just based on locality, or was there some data that was given that showed that that was the best test market to go?
Yeah, there were a few different markets that were identified by the agency. Dallas-Fort Worth was one of them. And one of the things that is actually, Dallas just set a record for being the #1 most dog-friendly city in America. And I don't know how they judged that, but it was something to do with real estate. So there's a lot of pet, passion people here in the Metroplex. And so we said, well, it works out for both of us because we're local, and it's one of the cities that the agency recommended.
Yeah, no, that's a very logical answer. Thank you. I will admit it took me for the first slide to completely understand that this was for people, not for not for pets, for a half a second. Are you this might be way too specific, but are you targeting it's a multi-part question. Are you targeting dog owners, or does the data say that dog people spend more money, or subscribe to these more often? And then with that, I don't know if this is a separate question or not, but is the curated versus created and the different content, is it like searchable by, I only want to watch cats, I only want to watch dogs?
Right. Great questions. So primarily dogs and cats. And I think that our content is probably similar to the ownership division, which is about 60-40, somewhere in there, favoring dogs. And we have different rows we have fun rows of content, what we would call a category, right? So we have, like, I think one is Bow Wow, and then another one is Meow Wow, which is, if you just like dogs. So we have different things. We have fun names for different categories, documentaries, movies, things like that. So if you go to watchbuddy.com, you can click the browse button and scroll all the content and see our library. Yeah.
Well, you'll see a new subscriber from Virginia later today.
All right. Excellent.
Mohammed, I'll let you jump in.
Oh, you're muted.
Yes,
there we go.
Let me unmute myself. Hey, how are you, Nathan? Good to see you again.
Good to see you again. Yeah.
Just a quick follow-up question. So since last time you presented, I would just ask, like, what progress did you guys make? And same as earlier with Enrichly, what is holding you back right now besides the financials? Other than financial, what could be holding you back? And having done a little bit more research after we spoke, I would say another question right now is, you say you are 90% of US homes, but are you actually currently tracking your viewer count and the traffic going to Buddy, or not yet?
So we let me answer the first question. So we're in 91% of connected TV homes. So if someone is just watching antennas or they're just cable TV, that's not a home that could watch us, right? So we're just going for the homes that have connected TVs, smart TVs, right?
Okay,
That
okay.
the internet is connected to the TV, right? And
Mhm,
of that, we're available in those homes. But you can be available, but of course, if you haven't gone to market to tell them you're there, no one knows. So that's that's so we're not at a place where we're measuring really any kind of traffic because it wouldn't really be meaningful. We haven't gone to market or done any advertising yet, so no one really knows we exist.
Okay, thank you, thank you. Just wanted to
Oh,
clarify that point.
since we last talked, we have 100,000 committed of the seed money. So since we last talked, we've made some progress there. And the only thing that's really that I can see that really holds us back is, the money to go to market and tell people that we exist. That's the primary thing. We have all the content ready to go. We're still occasionally making some original content, so we're adding to our original content library. But that's about it.
Thank you, Nathan.
42 seconds, not bad. I found my counter now.
Yes, got it.
Yeah, exactly. And can you just tell me a tiny bit more as the last question about the investment in original content?
Yes. So we long term, it is going to be original exclusive content that is going to grow this and blow this up, right? So right now we're say 80% acquired, 20% original. That will change to 80% original, 20% acquired at some point, right? We plan to grow our original library by recruiting YouTube creators and Instagram influencers to make original content for us. That's going to be our talent base to start with because they already have a following.
Mm-hmm. Thank you.
Already.
Thank you very much.
Love it, guys. All right. Well, without further ado, let's pass it on now to Coco Pelli.
All right, thanks for having me here. Let me get my deck shared here. All right, let me know if you guys can see that.
Yep.
All right.
We're good to
Thanks
go.
for having me here today. My name is Kelly Smith. I'm the founder and president of Kokopelli Outdoor, which is a multi-brand consumer products company. I founded Kokopelli back in 2012 out of my garage. So our two brands are Rover Products and Kokopelli. Again, I'll speak a little bit to Kokopelli first, since that's where the company started. It's a core outdoor brand focused on producing, designing, marketing, and selling ultra lightweight kayaks, pack rafts, stand-up paddle boards, anything paddle sports related. It's a very core user base that goes deep into the backcountry. In 2023, we acquired a brand called Rover. It was founded in Boulder, Colorado in 2016. It was a small team. We were a small team. We had a lot of synergies, and so we made the acquisition. Rover is in a much larger addressable market, and so we see a lot of growth, and we've had a lot of traction in just the past 18 months. So we're really excited, and that's the reason we're coming back to raise more capital. We have a very experienced team. Again, I founded Kokopelli in 2012, so I've been in the outdoor industry for going on 13 years here. Before that, I spent time in finance and accounting for about 8 years before starting Kokopelli. I'm really excited to talk about Reed. This gentleman is our executive vice president of sales. He joined the team about 18 months ago. We were wondering if he was going to be a good culture fit. A little bit elderly, has a lot more experience, but he's a surfer. He brings a lot of good vibes, a lot of good energy, and really, I think since the day we brought him on, we've just seen so much traction. And I'll talk about some of the success we've had that he's brought to the company. The second person I want to point out is Kyle. He's our director of marketing, been with the company 4 years. He spent time at a large billion-dollar plus company, Otter Products. They do phone cases. He was there early, selling $40 to $50 cases, commoditized, probably one of the most competitive industries. They're selling in AT&T and Verizon. He was in field marketing. He grew into brand. He then got experience at Yeti Cycle selling $10,000 to $20,000 bikes. And so to core outdoorsmen. So he has kind of the perfect blend of core outdoor, but can also sell in very competitive markets. And throughout this deck, you'll get to see some of his work. As I mentioned, the total addressable market, for Kokopelli, as we grew, it's a small niche market, call it $150 million. That's why, in 2023 and even before that, we were looking to acquire a company so we could really start growing the business. Rover presented itself, in an immediate TAM of $2.4 billion in the hard and soft cooler market. We're also selling drinkware, and we're going to be entering the wagon market next year with our first product. Rover is all about mobility and portability, getting you from point A to point B. From the outside, it looks like a cooler company, but again, all of our coolers have all-terrain 9-inch tires, making it the best wheeled cooler on the market. Our goal in 5 years is to be at $50 million. This is very exciting for us. At the peak of COVID, when we had a lot of demand, we topped out at 8 million. We've since come back down to 4.5, and now we're growing again. We have all of the customers in place to hit that $50 million. I mentioned Reed and his success since he came on in early 2024. He started February of 2024. We've onboarded with Dick's, Do It Best, Home Depot, Lowe's, True Value, Target, and we have our vendor number at Sam's and Walmart as well. Just getting the vendor number is not, that's the start. And then you want to start, selling online through drop ship. And once you prove that, you get in store. We are in store at Dick's. We're in store at Do It Best. And in 2026, we'll be in store at Home Depot. So as mentioned, we can hit our $50 million goal with all of these retailers here on this slide that we're already vendors to. In terms of revenue, company to date, we've sold over $25 million in products since inception. As I mentioned, our peak was at 8 million around 2022. We've come down, and after the acquisition, we've invested in the Rover brand, and we really are starting to see that trajectory up. We'll end this year a little over 5 million, and next year we're targeting over 8 million. It's about a 60% growth year over year. And that 60% year over year growth is based on pre-books. So we get preseason orders from Dick's, from Do It Best. So that number is already, partially booked. I talked a little bit about the history, started the company in my garage, kind of just throw away the 80% to the left. All the excitement is happening, more recently here with the acquisition of Rover, launching in Dick's. We're going to be expanding the number of doors in 2026 from 78 doors to 180 doors. We had great sell-through this year, and we're doing a 300-door test with Home Depot in store. We're here today raising a safe. The total amount of the safe is $2.7 million. 1.7 has already been raised and brought into the company, and we have $1 million remaining that we're looking to fill before the end of the year and into Q1 of next year at 10% discount, $15 million valuation cap. Largely, this is all going into sales and marketing. We've been told from our Dick's buyer that, look, we need to increase brand awareness. He would have increased more door count if we had more brand awareness. So we took that to heart and said, look, we're going to go raise the capital and continue to expand through our various methods of marketing and branding. There's a lot of M&A activity in the this category, both coolers, outdoor space, paddle sports, Arctic. This was a deal that the valuation was unknown. We believe they're in the 150 to 200 million dollar range. Igloo was acquired by Dometic for 400 million. We're looking at a 1 to low single digit revenue multiple on an exit, and low double digits on EBITDA multiples. So I'm going to dive a little bit more into the brands. So Rover, again, this is where we spend a lot of our time focusing on growth and scaling the company. Having a little bit of a hiccup on my screen here. It's not going down. Give me 1 second. I know what are we at, 7 minutes here?
We'll freeze the clock for you.
Sorry about that. No, it's okay. I'll move quickly. Okay, let me do this. I'm just gonna. Okay. I said I wasn't gonna be that guy. All right, let me find my share. All right, we are back. Okay, so problem solution. Again, it looks from the outside like a cooler company. Again, it's
Just
about
so you know, you're not sharing yet, just so you know.
Oh no.
Or at least I can't see.
Can anybody else see that?
Here it comes.
Okay.
There, I now see everything. I now see, there we go. Solution. Perfect.
All right, are you seeing the full screen?
Yep, looks great. Solution
Okay.
slide.
All right, so we are the only company with an all-terrain tire. They're pneumatic tires, 9-inch. So it makes it the easiest wheeled cooler, whether you're on the beach or just going from your car to the sidelines. Our core demographic, this is where we really differentiate. I think everybody knows Yeti, everybody knows some of the other cooler brands on the market. They focus on the outdoorsman, the hunter, the fisherman, wearing a lot of camouflage, with a lot of fishing poles. We're going the absolute opposite direction. It's one reason that Dick's really likes and resonates with our brand. We're going after the female buyer, the soccer mom, minivan, taking the kids from the parking lot to the sideline, or that day out on the beach. So we have very bright colors, very fashion forward, and again, that's how we differentiate the brand from our competition. We've already covered this slide. A lot of nationwide core retailers. We have a lot of building momentum with them. We do have 7 granted patents, 6 design, 1 utility with over 20 claims. The founder of the company, the designer, brilliant product design person. We have anchor pins that you can put umbrellas into fishing rods. We have like a chest set that is magnetic and sticks to the top. So it's all about good vibes and having fun outside. In terms of pricing strategy, this really will help you understand, how we do fit into the marketplace. There's Igloo, who's your good. Typically, retailers will have 3 brands on the matrix: good, better, and best. Igloo's the good, the entry-level cooler at $100 to $150. Yeti's that $400 to $500 cooler, made for keeping ice in your cooler from 12 days to 12 years. We're going to fit right in that middle zone. I think there is what people are calling Yeti fatigue, where people just don't want to pay $400 for something to put their beer cans or sodas into. And so we want to offer that lifestyle. We can resonate with the brand, but at the same time, be come in at a more reasonable price. Wide product assortment. We have over 30,000 customers since inception. We have over 100,000 social media following across all channels. PR and media, we won the Global Innovation Award at the Inspired Home Show, which is an international show earlier this year on our Roller 45 cooler. I know we're coming up on time here, so I will breeze through Kokopelli. Again, problem, large, hard shell kayaks, hard to transport. All of our boats are inflatable, so you can roll them up, keep them in a small backpack, pump them up when you get to the water. Again, smaller addressable market than the coolers. We market to anywhere from a beginner to intermediate to advanced whitewater paddlers. We use a lot of our inspirational expert paddlers in our marketing to bring other consumers into the brand. Again, we have what we call mild to wild. You got your lake boats, you got your intermediate kind of dabbling in some whitewater, and then you got your professional, whitewater kayak designs. Selling in REI and a lot of specialty retailers, and we just found out we're going to be going into West Marine as we enter 2026. Again, high customer ratings, a lot of media, product of the year, gear of the year, best in show. Again, the brand's over 10 years old, very established. So with that, I'll wrap and open it up to Q&A. And sorry for going so fast. I know that was a lot.
No, that was great. It's a lot to absorb. I haven't seen that one before. I'm not sure if this is a combination question or a reflection. Is that the Rover? I'd be curious, what is the client mix on it? Because when you, towards the end of the presentation, sort of switched to talking about a lifestyle brand and everything from, the IP and the umbrella and the chests, and it made me view it very, very differently than, oh, it's another Yeti with wheels. And I'm curious how you're going to market with the lifestyle concept, as well as if your sales are coming, where your sales are coming from, which piece of that target market.
Mm-hmm. Yeah, let me digest the question and just make sure I understand it.
Yeah.
So you're wondering how we market to, one group of people on the Rover side and then a more kind of hardcore type of person on the Kokopelli side?
No, I apologize. I didn't communicate my question well, because I was thinking of it as I was saying it. As opposed to Yeti, let's just stay on the Rover side.
Yeah.
As opposed to Yeti, who's like, hey, we've got a cooler. You're going after like the lifestyle concept, right? It's got like the chessboard and like all kinds of fun other things you can do with it. So I'd be curious of the customer base or the people that are showing interest. Is it more outdoorsmen? Is it more like, hey, this would be a fun thing for my family to bring to the beach or camping? Like, can you tell at this point, or since it's all sell through, you don't really have all that data yet?
Yeah,
Did
no,
that
it's
make
a
more
great
sense?
question. It's a very difficult one to answer. I think right now, those three core demographics, really beach is where the product is resonating. So the buyer, Dick, said, look, we're going to put you in all 80 beach locations. We just got the nod that, okay, we're going to expand to his other, 180 coastal locations. So he's really gung-ho on this beach. It's the best wheel cooler. It's the best cooler for the beach. And so we are getting traction in that market. But really, the broader goal of the brand is to resonate with the sideline as well, the soccer mom. Again, taking the high seas and the orange slices and giving them smaller options. Again, Yeti, the competition, 110 quart, you could pack out a full elk. We want to do a 30 quart that you can take a couple drinks and snacks to the sideline without breaking your back.
Thank you. I think it just helps me identify also that the hunters, the Bass Pro Shops is like sort of a there's only a certain level of competition in the Venn diagram because they aren't going after the market you are as much and the wheel part of
Correct.
it.
You would not see a Yeti in a Target or a Walmart or a
Right.
Costco, and those are the accounts we're going after. And I don't think I touched on Target. We got our vendor number. I can't say anything now. We've gotten a verbal that they want to test, but they're still waiting on their layout for 26, and so there's no firm commitment, but we are onboarded as a vendor.
Great. It's a lot of big names and great progress. I don't know, Mohammed, if you want to jump in.
Yeah, thank you. Thank you, Kelly, for the presentation. It looks like an interesting product. You have a good team put together and already a list of partners that should make it easy for you to kind of make it compelling for investors. Um, my question is twofold. The first one would be, what current sell-through reorder velocity at national account? Like, what's your current sell-through? And what's the threshold for you pulling or expanding? Do you already have that kind of visibility, or are you still working to kind of define it?
Yeah, that's a great question. And we do have the answers. I was just looking at Dick's sell-through. We're at 72% for 2025. About halfway through the year, he noticed he was low in two of the colors, so he did an at-once order to replenish those. But typically, they'll order in a spring, summer, and then a fall. So that was just the spring, summer. He went ahead and placed the fall order, which was roughly a third of what the spring, summer is. And now we've gotten the forecast for 2026 spring, summer, which is where he said, look, we're going to go from the 78 doors to the 180 doors. So we do have the sell through. He was happy with it, and now we're expanding. What I can't answer is with all these other larger accounts that we're just now getting into. So Home Depot will be in store come February, March of 26 for the first time. And that's where we have to prove sell through going forward.
And with all these partners coming on board, like Home Depot early Q1 of next year, will the seasonality kind of have an impact on your working capital because you kind of need to prepare for it, right? Like have the inventory, ship it out. So it's almost kind of like you have to front load the money and then hope or that they sell. But like how are you doing to mitigate that? Or like what are you doing to mitigate the cash crunch that seasonality creates?
Correct. It's a very seasonal business. You're exactly right. I think I've gotten a lot of practice from Coca-Cola because it's even more seasonal. Nobody wants to be out in the water if it's not 90 degrees. With the coolers, it is more of a 3-season product, so it stretches out a little more. You're exactly right. There is a cash crunch period, typically around Q1. What we're experiencing now is Home Depot is actually shipping in December. Dick's will ship in January, February, and then other retailer, more on the Coca-Cola side, it will be March, April, May. So it is stringing out. We do have factoring and PO financing that we've used in the past to help offset that. So this raise and the safe that we're raising is not to fund working capital or inventory. It is purely to go into sales and marketing activities.
Thank you, Kelly. Great answers. Thank you.
Yeah, and just a little closing side note is your exec team is is very impressive, and but when you combine although Reed might not be appreciate being called elderly, maybe we'll go for maybe we'll call him older, not elderly next time.
Bit my tongue.
Yeah, as a 55-year-old, I've just transitioned to people calling me ma'am, and that's not my favorite either. But anyway, yeah, so the team is extremely impressive, and when you couple that and your current success, and when you couple that with these partnerships, yeah, it's really impressive. So I'd love to follow up with you with a couple other things.
Thank you. Well, let me say, Reed brings a lot of wisdom to the table.
Don't backpedal now. No. Great. And I again can't see a timer, so I don't know if we're
No, my bad, guys. I just didn't want to interrupt. That was great discussion. So I was like, I'm just going to let it flow for a little bit. But without further ado, guys, great presentations. We're going to move on now to William Price Distilling Co. So if you would like to put up your presentations now, my friend.
My name is Brian Clary. I'm the co-founder and CEO of William Price Distilling, and we're focusing on crafting the future of coffee cocktails. And right there is a picture of our cold brew coffee liqueur, as well as our awards. We've won a gold medal at San Francisco World Spirits Awards, which puts us in the top tier of coffee liqueurs across the world. We've also won Best Coffee Liqueur in the nation in 3 different years at American Distilling Institute. So out of the 3 years we submitted, we won first place. And then we also got a double gold at John Barley Awards. So what we're focused on is setting a new standard in coffee cocktails, developing a lifestyle brand that is at the intersection of craft spirits and premium coffee. So what we see on the shelf, the marketing opportunity that we see is coffee is the world's number 3 most drank beverage, next only to tea and water. And millions of consumers have a daily ritual and a relationship with coffee. So we want to expand on that and bring that into the coffee liqueur segment. Our defining market scope is our TAM, SAM, and SOM of 4.2 billion for the coffee liqueur market. The SAM is 1.5 billion for the US premium spirits, as well as the RTD, hard coffee. And then our SOM is 25 million that we expect in our 5-year revenue forecast. Just so you know, there is some headwinds in the alcohol space. However, coffee liqueur is at a 3.5% year-over-year CAGR. So it is a subset of the liqueur and alcohol space that continues to grow versus other ones. And that's mainly due to espresso martini sales. We do see that continuing to grow at 50% year-over-year. And the other part of the market, it is dominated by one player in coffee liqueur, and that is Kahlua. The rest of the market is very fragmented and presents a lot of opportunity for local as well as premium products to step in. Slide. So again, our coffee culture is booming in the US. There are small premium coffee shops opening up all over the country. And we don't see that developing in the coffee liqueur space. We see Kahlua as a mass marketed, not very authentic, and doesn't have much craft appeal. It's a legacy brand that hasn't kept up with the evolution of the coffee culture. And we like to take advantage of that lack of evolution from Kahlua and develop a brand that people can have a personal relationship, just like they have a personal relationship with how they take their coffee in the morning. So our solution, again, premium coffee liqueur brand. We do have proprietary recipes that we're using right now. We've won those medals. We'd like to position our coffee liqueur, and you can see there's some pictures here of our coffee liqueur in restaurants as well as at our tasting room. And we are focusing on that lifestyle part and the premium quality that we bring. Our target market is the Gen Z and millennials, females that are interested in especially the espresso martini, willing to pay a premium for that, and they seek authenticity and a brand that they can connect with and become part of their identity. We do have a launch pad that we're focused on, and that is the Houston market. We are a Houston-based company. Houston is about 7 million in the metro area. I believe we're about ready to take over Chicago as the 3rd largest, but right now we're the 4th largest city. We are going to focus on that market and build our local brand. There's a lot of opportunities. There's a lot of restaurants. We have, I think, most restaurants and bars per capita than other cities. And we have our direct-to-consumer tasting room. So we have a 17,000 square foot facility with 2,000 for a tasting room and 5,000 for an event space amongst our production floor. So we really like to drive sales through that tasting room and then further expand on the products through distribution. After we hit resonance at that level in Houston, we look to further expand across the Texas metro areas. Texas is a brand in and of itself, and people in Texas love to buy Texas brands, with further brand expansion in further years. So our sales channels are focused at our tasting room, and you can see there's a picture of our Gatsby party we had a few years back. It's an open space for a lot of events. We can hold 250 people at our event space. We do a lot of experimentation in the tasting room. We bring some various products to market. So we also have a Texas pecan coffee liqueur. We have a hazelnut coffee liqueur, and some other products that we expand there and focus there. And then we also have the distribution side, so our on-premise and off-premise sales, so products that are drank at bars or restaurants. We have some great accounts in the Houston area as well as across Texas right now. The espresso martini is driving a lot of those sales. And then our off-premise is the liquor stores and grocery and retailers. Specs is the largest Texas liquor store. We're in that, as well as Total Wine and some other retailers across the country, across Texas. A big part of what we're looking to expand to is we've taken our coffee liqueur, we've reformulated it with a wine base instead of a liquor base. And due to state level liquor laws, this will actually open up the grocery store channel. In Texas, grocery stores can only sell beer and wine. Liquor must be sold through liquor stores. So we've actually found a way to formulate our coffee liqueur into a ready-to-serve espresso martini. We're not focused on canning right now. We're focused on a multi-serve, 5 drinks per bottle in a liquor-sized bottle, and that will open up. That will open up the grocery store chain as well as the convenience store chain, with an opportunity to compete in the larger ready-to-drink market of the 19.4 billion. We don't see a lot of this wine-based espresso martini in the market. We do see some liquor-based, but in Texas, those are still kept to the liquor stores. We also do see some wine-based in coffee, but not in this value proposition, and those usually come in can form. We're not focused on can right now because it degrades the quality of the product. We want to keep a higher quality product. We do have some traction. We've been in business since the pandemic. We actually opened in 2020. We've had a total revenue of 3.2 million since our inception. This has led to 250, and we're actually in about 300 total accounts so far across the on-premise and off-premise through distribution. We've also had over 110,000 people through our tasting room. And one of the reasons why we're focused on our coffee liqueur is because we have over 4 out of 5 products that we sell through the distribution channel are our coffee liqueur. We do make other products, including whiskey, vodka, gin, limoncello. We do have some rum as well. Those are mainly focused on our tasting room. The whiskey has the second most sales across other distribution channels. However, our coffee liqueur makes up over 80% of our distribution. We are going to use these funds for growth. We're focusing on the brand marketing as well as extending our runway a little bit more. Liquor companies are marketing companies that just so happen to sell liquor. So marketing is a big focus of ours going forward, and we're trying to create brand evangelicals, tap into that market and create people who love our product and keep coming back over and over again, and build that brand awareness across Houston, and then expand distribution across Texas. Our team is me and my business partner, Zachary Hiller. We are the 2 pillars that are working on this day in and day out. He's focused on sales while I'm focused on meetings like this, raising funds, driving the brand strategy, as well as the on-site production and development of products. We have additional strategic advisors, including our lead investor, Robert Kasperzak. He has scaled a multi-billion-dollar diagnostic medical business. as well as his advisor, Kevin Spivak, who has been in Seagram's and Patron joint venture and has experience in a global brand and distribution of this type of product. Our exit strategy is a tried and true tested method. It's basically going to go to a large scale liquor company, Constellation Brands, Bacardi, Campari, Heaven Hill, and Brown Forman. Those are the ones that are primarily going to be in the market. Diageo is not in the market because they actually own Kahlua. So if they do come a knocking, they're trying to get rid of us versus trying to buy us and grow us. We do have the award-winning product of the coffee liqueur, so that is something that puts us on a forward footing for brands looking to acquire us. We're looking to have a 5-year horizon for our target exit. The revenue multiple, the market is based on more revenue multiple versus EBITDA, and that's just based off the number of case sales you can have. And our target is about 5 to 8x, while the median is currently 8.8x over the past 7 to 8 years. And we'd like to see ourselves in 3 to 5 different states of distribution, including Florida, Illinois, California, and New York. Those are the top 5 states for distribution. But we can also do other regional distributions such as Louisiana, Oklahoma, New Mexico. Those are ones that we can touch. We are doing a convertible note. We're looking to get $2+ million with, we're looking at $2 million with an over commitment of $3 million. If we get more than we're looking of that $2 million, we are going to look to continue to grow even further and have a higher growth percentage. We have a 1.1 soft circled right now. Our existing angel investor has pledged an additional 1 million to this round, as well as we've raised and have soft circled 100K from a new investor. We are looking at 8% interest and a 20% discount. And that is the end of my presentation. Open up to any questions.
I was actually so compelled I wasn't writing notes. Let me just move this out of the way here. Do you want to start, Mohammed?
Yeah, absolutely. Hey, William, thank you for the presentation. Very thorough. I have a simple question, really. This is not a space that I am very familiar with, but given you stated CAC to LTV by channel, like tasting room versus on and off premise. What mix gets you profitable? Do you already have an idea of like what is the avenue or the channel that you want to really pour money into?
I would say that would change over the course of time. If we can put 3 to 6 months focused on our tasting room and grow that channel the fastest, that is the highest margin and highest opportunity for what I would say are easy wins. It's more operating as an experience center and an event space. We're one of 2 distilleries in Houston, or out in Topeka. We're one of 2 distilleries that have a tasting room in Houston. The other one being an extremely large one on the side of town, which is more industrial, while we are actually surrounded by a neighborhood. We have 2 craft breweries within Stone's Throw and a craft winery as well. So if we can raise our monthly sales, we're around 45,000 a month right now. That gets up to about 70,000 in October, November, December, just because we have a lot of holiday parties. In fact, yesterday we had 2 different events, a 100-person event as well as a 50-person event. We had one alumni group holding an event there as well. We have about 35 events I know booked out through the rest of the year, including some major holiday parties. That gets us, if we can get that to 75 to 100,000, that gets us to a high floor to continue to then put money into the distribution channels. So the distribution channels have more long-term growth and aren't limited by the number of locations. Again, we only have 1 tasting room. we want to continue to grow tasting room and physical footprint. There is the opportunity of opening, a bottle shop or a tasting room downtown and those kind of things. However, that is more capital intensive. Whereas once we hit our floor or our ceiling at the tasting room, we can then put more focus growing the brand across the on-premise and off-premise. We are somewhat, I would say about 30–40% focused on growing the brand outside. We have our bartenders who actually work 4 days a week in the tasting room, and then 2 days a week they go out and do sales. So they're tapped into what sales look like in the liquor store as well as other bars. It's easier to get into a bar than it is to get into a major retailer. It is somewhere in between to get into a mom and pop liquor store. It's easier to sell more product at a Total Wine than it is at a bar or restaurant. So you're kind of trading off growing the brand, which is in bars and restaurants doing espresso martinis. That gets more exposure. If you can imagine how many more people are drinking espresso martini versus the competition of every single bottle in a liquor store. However, we do tastings in Total Wine, and whenever I do them, I have a 50% liquor to lips conversion rate. So for every 2 people I taste, I usually get 1 to 5. So the quality of our product gets people to buy. Sorry, I went a little over on mine.
Thank you.
Thank you.
All right, guys. Well, with that, that finishes up our presentations for today. And we will be having breakout rooms. So if you guys are still sticking around, that'll give each of you to hop into a room, ask any questions, have a little bit more of an in-depth conversation about what was talked about today. So that pretty much sums it up. Usually Hall has like an ending statement, but today we'll just hop right into it. So I'll just open up all these rooms. If you were not assigned to one, please feel free to jump into one. And there you go, guys.
Thank you.
Thank you.
Thank
Thank
you.
you. Bye, guys.